Hi there, it's Damian from the Peak Partnership again. It's hard to believe, but this is the third consecutive year we've had to pause our budget breakfast event, thanks to COVID, the recent floods, and people generally having to deal with greater challenges than making it to a 7 a.m. breakfast. So, without the bacon and eggs, here we are at our new normal, our video summary of the key points of the 2022 federal budget. Please grab a coffee, settle in and enjoy. We're just going to have a look at the federal budget for 2022 and Peak's take on the benefits and also the losses that are incurred in the budget. Firstly, the legal stuff. As you'd understand, this is just very general information and doesn't account for your individual circumstances. We'd need to look at things like your taxable income, the amount you've got into superannuation, etc. before giving any specific advice. But please contact us if you'd like to know more about any of the issues we raise. So what were the highlights? The deficit is not as bad as forecast in the mid-year economic statement. They're attempting to address the recent rise in the cost of living. They're helping home loan buyers, creating more jobs via small business support, strengthening the regions and infrastructure spend, supporting women, children and health, and of course a big ticket item, the national security and defence spend. So let's have a look at each of those in turn. The deficit, what does it look like? As you can see from the graph there, the projection is that it's actually going to reduce in deficit over the period to 2026. At the mid-year forecast, it was estimated that the 23 deficit would be somewhere in the region of $98 billion. They have now revised that to only be $78 billion. The savings since December through to March has really been the increase in the commodity prices, of course, which the government gets a royalty fee for. And you can see there that 3.4% of the GDP is the amount of the deficit, and that's projected to reduce to only $43 billion in 2026, which would be 1.6% of the GDP of Australia. And when you have those losses year on year, obviously our net debt continues to increase. So you can see there our net debt forecast for the end of 2023 is $714 billion, stretching out to 2026, which is $864 billion. But just a reminder, even at $864 billion, that's 33% of our GDP. That's still well ahead of most European and Western countries, which in some cases are over 100% of their GDP. Given we've got a low interest rate environment at the moment, that amount of debt is not going to be a problem. It's just a matter of getting the budget forecast back into surplus. The unemployment rate has been quite a bit of a surprise. We're at 3.75%, and that's expected to plateau through to 25 and a small kick up in 26. And that 3% forecast is below 3% the forecast, and is the lowest we've seen since 1974. So we're getting to a situation where there is almost full employment for those who want a job. The cost of living, it's been on everyone's lips, and obviously given that we've got an election coming up in a couple of weeks, it would have been probably erroneous of any political party not to address some of the costs that have now happened. So what they're doing is a $250 one-off payment, which is obviously tax exempt, to almost 6 million welfare recipients next month, April 2022, and that'll automatically be paid through the Centrelink program at a cost of almost $1.5 billion to assist with the cost of living. The headline item probably for most of us is that petrol is going to get cheaper. The fuel excise will be cut by 55 cents, so they'll cut 22 cents off every litre, and that'll flow through in the next couple of weeks, and that'll happen for 6 months through to September 2022. And that applies to both petrol and diesel, and there are huge fines from the ACCC for any non-compliance with fuel retailers. Just note it doesn't apply to aviation fuel, so we can't expect a drop in the cost of airfares. And then there was also an income support payment increase in this month, March, of about 2.1%, which increased the rate for individuals by about $20 and $30 for couples per fortnight. And as usual, there'll be a further increase in September 2022, and we think it'll be at a similar amount of money. Now, these aren't the $1,500 we saw with the previous giveaway, so we don't think anyone's going to be rushing out to Harvey Norman to buy themselves a new flat-screen TV, which probably isn't a bad thing and wouldn't help our net imports. The next item was family housing. So there's been a little bit of work done further in stimulating or getting low-income people into the housing market. So there's a family home guarantee, and there's 5,000 places for single parents with at least one dependent to obtain a loan with just a 2% deposit. Regional home guarantee, there's 10,000 places there for home buyers in regional areas, and again at a reduced deposit and with no mortgage insurance required. And thirdly, the first home guarantee. It's 35,000 places for the first home buyers with just a 5% deposit, and again no mortgage insurance, and it's the federal government that will be guaranteeing those homes instead of the mortgage insurance. The best placed here will be people with income up to $125,000 individually, and couples up to $200,000 in annual income will be eligible for home guarantee placements. Now in total there's 5,000 for the family home, 10,000 for the regional, and 35 for first home buyers. So that's 50,000 homes each year up until the 30th of June 2025. Just having a look at business now, there's mainly targeted in the areas of trying to build employment and maintain skill sets. So there's a $5,000 payment for new apprentices in priority industries from the 1st of July 2022. There's also up to $15,000 in wages subsidies for employers who take on new apprentices, and those two initiatives cost almost $2.8 billion in total. There's a 20% break. In fact, what happens is you get an additional 20% deduction on external or online training expenses done through a registered trainer for small businesses, and that's the ones with less than $50 million worth of turnover, through to 30th of June 2024. There is a little wrinkle with these 20% tax breaks in that it can only be claimed in the following financial year, and obviously reduces the amount of tax payable and not a refund. The other 20% break you may have heard of was also around business expenses and depreciating assets that support digital adoption. One of the big ticket items in the budget is digitisation of business records. It also means that the government is getting more information more readily from most of our employers, and so we need to be a little careful with how much information we're handing over. The 20% tax break on the depreciating assets and digitisation is capped at $100,000 annually and will be there through to 2023, and once again applies to the SME market of $50 million turnover or less. Patent box was a special little thing they brought in the last budget that applied to biotechnology and medical sector, now being extended into agricultural and low emissions technology. If they're doing the R&D in those areas, they have a flat rate of 17% tax, which obviously helps in terms of the net reinvestment for further R&D. There's been a proposal put forward that the businesses can choose to have the ATO automatically calculate their instalments, so their tax instalments, PAYG standing for pay-as-you-go instalments. That won't be expected to be in place until the 1st of January 24. There's obviously some software issues that have to be dealt with, and obviously that's part of this passing through of information to the tax office. This is a system that's available currently in New Zealand, where the IRD over there calculate the tax on a quarterly basis for their employers. The alternative, and what we have at the moment, is that the PAYG instalments are set at a uplift factor, and that's almost 10%. They're now saying that that'll be reset to 2% for the 22-23 year, and again available for the SME market with less than $50 million in turnover for the PAYG instalments, and $10 million in turnover for GST instalments. Just note, that is just a delay in timing of tax payable. So as it denotes, PAYG is just payments in advance of your tax for the end of year. It still doesn't change your end of year tax bill. It'll just mean that there'll be larger lump sums to be paid once the income tax returns are lodged. So it will require better cash flow management by our employers. The temporary full expensing, so it's the write-off for immediate tax deductions for eligible assets, will continue through to 2023. There's been no further announcement of that extension, but maybe we'll see a return to the instant asset write-off scheme, which will have a cap on it and the amount of technology, assets, manufacturing, equipment, etc. that you'll be able to buy. So again, the government trying to stimulate business growth through the payment of plant and equipment. And a little one, odd piece of tax legislation was really a product of its time, the loss carry back tax offset, which was being able to utilise where you've paid tax in 1 year and then the following year you had losses, generally incurred over the COVID period, where maybe 2019 you were profitable, 2020 or 21 you had losses because of the COVID issues. That won't be extended past 2023. In other matters, infrastructure, again, one of the big spend ticket items in the budget, $17.9 billion in additional funding committed to road, rail and community infrastructure projects with both existing and priority works, and they estimate that'll create 40,000 jobs nationally. Queensland gets a fair slice of that at $3.3 billion for funding for urban roads and rail projects, which includes $1.6 billion for the Brisbane to Sunshine Coast Rail Extension, hopefully get past Landsborough, the $1.1 billion for the Gold Coast to Brisbane Faster Rail Upgrade, which is those are cattle trains at the moment with the amount of people that are using them, and $190 million for the Mount Isa to Rockhampton Corridor Upgrade. Why there? Well, if you consider the mining that goes on at Mount Isa and the Rockhampton port, you'll understand that there's areas there where they're heading towards getting more commodities out onto the sea. There's also $1.7 billion in transformational infrastructure in 4 key regions, the Northern Territory, North and Central Queensland, the Pilbara, and then the Hunter, all of which are obviously mining areas to harness export growth opportunities. Again, the government making sure that their take of the royalties continues into the future. Working Australians. So income tax, this is one of those budgets where there really hasn't been any changes in the income tax rates. So we're not changing anything for 2022/23. As you can see, again, we've still got progressive income tax rates starting at 0, going through to 45% when you're on $180,000 or more. There are projected stage 3 tax cuts, and these have been on the board for a while, and they'll continue to start on the 1st of July 2024, with the 3.2% tax rate going and being cut to 30%. So then we'll have a 30-cent tax bracket, which will go from $45,000 right through to $200,000, which brings it in line to most of the company tax rates, and therefore there's no arbitrage trying to save money by keeping it in a company. Probably a new term that came in last year, the Lamington tax, or the low to middle income tax offset, lives on for 20 and 2022 financial year and does receive a one-off increase for an additional $420, which we'll cover now. So that low to middle income tax offset effectively increases to a maximum of $1,500, and the major winners in that tax bracket are $48,000 to $90,000, where you get the full $1,500. It's a one-off payment. It's a one-off increase in the tax offset. It's not a physical payment, so don't expect to be getting a check in the mail from the tax office. It only occurs an offset against your personal income tax return once you lodge it, and it only offsets against the actual tax payable, so there's no refund available there. Senior Australians. The more experienced people would know that there's been a pension drawdown of 50% reduction. That's been now extended through to 2023 out of your superannuation fund, and that was originally introduced to combat the drop in returns over the COVID period on retirement funds. So the super funds weren't making as much money, and therefore by drawing down the minimum requirements, it was actually eating away at the capital. So the pension minimums are now based on the super account balances and your age. And you can see there the minimum draws start at 2% through to 7% of the balances as at the 1st of July 2022. So superannuation, as I said, probably nothing new, but there are some things worth a mention that will change from 1st of July 22. Superannuation guarantee, which we all know is at 10% at the moment, is now going to be paid on $1. There's previously been an exemption for the first $450, which is generally to enable those on low incomes not to be getting SGC. They will now receive SGC and go into a superannuation fund on their behalf. Individuals aged over 60, that's dropped down from 65, can now make up to $300 per person in downsizer contributions to super on the proceeds of the sale of their home. Hopefully that home they would have held for more than 10 years as their principal place of residence, and can obviously get up to $600,000 worth of monies into superannuation. You ask the question, why would you do that? Well, in the superannuation environment, individuals over 60 who are in pension phase pay no tax on the earnings on that $600,000. So obviously much better environment in terms of return if you're not paying any tax on your returns versus in your individual hands. And they also repealed the work test, so there's now applies between 67 and 75. So if you're in that age bracket, you're able to claim personal superannuation contributions without having to prove that you're still working. Therefore, they're allowed to make non-concessional contributions and increase their superannuation amounts and get a tax deduction of up to $27,500 a year. And interestingly, they increased the First Home Savers Super Scheme, which is a scheme where people who are buying their first home can voluntarily take money out of their superannuation fund, and that used to be a maximum of $30,000. That's now increased to $50,000. So there might be a nice plan there where you actually increase your superannuation contributions rather than hold the money outside of super as you're saving towards your superannuation, saving towards your first home. So health and well-being, always on the budget, but there's $1.3 billion now been allocated to combat violence against women and children, and that's hit our screens, unfortunately, in big ways in the last 6 months. $547 million for mental health and suicide prevention, and $450 million has been allocated to women's economic activity for expanded paid parental leave and senior leadership development. $360 million for women's health, including $58 million for endometriosis and $81 million for genetic testing. Defence and national security has been a big issue, obviously, given the recent events in Europe, and our commitment now is the $38 billion through to 2040, so that's quite a time, but they're aiming to recruit an additional 8,500 numbers in new personnel, which will beef up our internal defence, and $9.9 billion invested over 10 years for the interestingly acronym named Red Spice Package, which is a resilience, effects, defence, space, intelligence and cyber enablers, and that enhances our Australian Signals Directorate. If you haven't heard of the Directorate before, it deals with most of the cyber security issues here in Australia and is responsible for protecting Australia from any cyber threats. So I think that's money well spent given the current environment. $10 million for future naval infrastructure. So we've been told there's going to be a new submarine base somewhere on the east coast of Australia. 3 different locations have been mentioned, and I guess there probably won't be a decision on that until after the election. We'll have 2 unhappy ports and 1 very happy port. $136 million to maintain our border force, marine surveillance and response capabilities, and $116 million to boost Australian Criminal Intelligence Commission capabilities. And an interesting one, $66 million there to protect Australians against convicted high-risk terrorist offenders. So hopefully we'll be able to spot them pretty easily and turn them away at the border. The environment has some commitment here of $2 billion for sustainability initiatives, including protecting the Great Barrier Reef, which once again has got some international coverage. We're going through another sort of degradation area there in the Barrier Reef, and a commitment to be net zero by 2050. $60 million to the Recycling Modernisation Fund, developing new technologies to combat problematic plastics. So those are the long-lived plastics that hang around in the environment. We're seeing a lot of that now going through the life cycle of birds and fish and finding their way to humans as well. $247 million over 5 years to support increased private sector investment in low emissions technology. You probably remember that as a country we used to export a lot of our rubbish overseas. We're now having to deal with that on site. Don't forget, we're getting towards the end of financial year, and we'd obviously love to have a talk to you before we get there in terms of saving some tax and increasing your cash flow. One of the ways we remain in contact with you is through our mobile app. You have the ability to download that for free, whether you're on Android or Apple. Just search for My Accountants, and it'll ask you for a password, and that password is PEAK in capitals, P-E-A-K, and you'll get free access to our mobile app, which has 17 financial calculators, the latest tax tables, and even a GPS-enabled mileage tracker, so you can do your logbook for your motor vehicle, photographic receipts, and also an income tracker, ASX markets, and plenty of information. And we will be pushing some information through that towards the end of financial year to help you with your end of financial year planning. Well, there you have it. That's the federal budget for 2022. We hope you found some value in the presentation, but if you have any questions, you can contact us through our website or message us directly at email at, that's the @ symbol, peakpartnership.com.au. And you can request a copy of our budget report on our website at the address shown below. Lastly, end of financial year is not that far away. So if you'd like some help with either cash flow planning or tax planning, we suggest a review meeting with us well before the 30th of June. Again, just go to our year-end planning webpage to book a time. Thank you for watching. Stay healthy, get wealthy, and be wise.